Now let's talk about natural resources. And natural resources is considered to be one of the long-term assets. Some businesses own natural resources such as timber, minerals, or oil. The only difference when we compare natural resources to other kind of fixed assets is that they are subject to depletion instead of depreciation. So the characteristics of natural resources are as follows. One of those things is that it's naturally occurring. So an asset that is created through natural growth or naturally through the passage of time. For example, timber is a natural resource that naturally grows over time. Another thing is removed for sale. So the asset is consumed by removing it from its land source. For example, timber is removed for use when it's harvested, and minerals are removed when they are mined. They're also removed and sold over more than 1 year, and that makes it a long-term asset. So the natural resource is removed and sold over a period of more than 1 year. If it's something less than a year, we don't consider it to be a natural resource. Natural resources are classified as a type of fixed asset. I like to call it long-term asset. I think it fits the title more than calling it fixed asset. The cost of a natural resource includes the cost of obtaining and preparing it for use. So, and as natural resources are harvested or mined and then sold, a portion of their cost is debited to an expense account called depletion expense, and that's equivalent to depreciation expense. So how we calculate the depletion is determined as follows. It has to go through these two steps. The first step is to determine the depletion rate, and it's very similar to the units of production or units of output depreciation method. So we have the cost of the resource divided by the estimated total units of the resource. The cost of resource is a fact. We are always given that. The total units of the resource is an estimate. So this is something that the accountant has to estimate. Of course, in our case here, these estimates are going to be given to us. The second step is that we multiply the depletion rate by the quantity extracted from the resource during the period. So the depletion expense would be the rate that we got in step number 1 multiplied by the quantity removed during the year. So let's see this example. Assume that Cars Company purchased mining rights where we have the cost of mineral deposits about $400,000. We have the estimated total units of resource, 1 million tons, and that's an estimate. The tons mined during the year are 90,000 tons. So the depletion expense for the year would be computed in following these two steps. The first step, again, we have to calculate the depletion rate, where we get the cost of the resource, or the cost of resource, divided by estimated total units of the resource. And the cost in our case here, it's given to us as 400,000, so we use the 400,000, and the estimated total units of resource is 1 million tons, so we divide it by the million ton, and it turns out to be 40 cents per ton. Then we use this 40 cents per ton rate in order to calculate the second step, which is the amount of depletion expense. So we take the rate per ton multiplied by the 90,000 tons that we mined during the year, and that gives us $36,000 depletion expense. So how does the adjusting entry look like? So the adjusting entry to record the depletion would be debiting the depletion expense and crediting the accumulated depletion, and again we use the $36,000 that we just calculated. So like the accumulated depreciation account, accumulated depletion is a contra asset account. It's reported on the balance sheet as a deduction from the cost of the mineral deposit. So we'll see that in property, plant, and equipment we use accumulated depreciation. In natural resources we use accumulated depletion. But in other kind of intangible assets that we'll cover in the next part, we really don't use the word accumulation anymore. We use the intangible asset right away. So let me skip the checkup corners. I'll leave these for you to practice, and let's talk about intangible assets. So what are intangible assets? These are assets that lack physical existence. So they don't exist physically. So long-term assets that are used in the operations of the business but they do not exist physically are called intangible assets. These assets may be acquired through innovative, creative activities or from purchasing the rights from another company. So some companies would have their R&D department and they would come up with their own intangible assets. Some companies, they just purchase the right of these intangible assets from other companies. So what are some examples of intangible assets that we need to know? Patents, copyrights, trademarks, and goodwill. These are the common form of intangible assets that we'll see, and we'll see how they are used in accounting. So the accounting for intangible assets is similar to that for fixed assets. The major issue are determining the initial cost, and the second thing is determining the amortization, which is the amount of cost to transfer to expense. So amortization is very similar to depreciation in property, plant, and equipment, and depletion for natural resources. So I want you to remember these three terms, and they mean exactly the same thing. Depreciation, depletion, and amortization. They all have the same meaning. However, the only difference for amortization, we never use the term accumulated amortization. That's not very common. So we have the accumulated depreciation, we have the contra asset for depletion, which is the accumulated depletion, but for amortization we would use the intangible asset value directly. So amortization results from this passage of time or decline in the usefulness of the intangible asset. So which is very similar to the definition of depreciation or depletion. So now let's talk about patents, and patents is one of those examples related to intangible assets. Manufacturers may acquire exclusive rights to produce and sell goods with one or more unique features. Such rights are granted by patents, which the federal government issue to investors. So any kind of simple item, something like I have here a stapler, you can see that this has a patent. The way it works maybe has a patent right. So if another company wants to produce or sell something similar to this, they have to have the patent right. These rights continue in effect for 20 years. After 20 years, it just belongs to everybody. So the government issues this kind, or the federal government issues this patent right only for 20 years. After that, it's owned by anybody. So a business may purchase patent rights from others, or it may obtain patents developed by its own research and development. The initial cost of a purchased patent, including any legal fees, is debited to an asset account. So this cost is written off or amortized over the years of the patent's expected useful life. So the expected useful life of a patent may be less than its legal life. For example, a patent may become worthless due to changing technology or consumer tastes. But the longest is 20 years, and that's what we call it the legal life. So let's say we have a fidget spinner. Remember those kind of things that they used to spin? Let's say they were only good for 3 years. Even though the patent for this thing, the legal patent, is 20 years, but we should expect that its technology or its use is going to be only for 3 years. So in this case, we only amortize it over its technological life or its practical life, if I can say. So patents amortization is normally computed using the straight line method. The amortization is recorded by debiting an amortization expense account and crediting the patents account directly. We don't use an accumulated amortization account. A separate contra asset account is usually not used for intangible assets. So please remember that. We don't have a contra asset like an accumulated amortization. We don't use this kind of account when it comes to intangible assets. So let's see this example. Assume that at the beginning of its fiscal year, a company acquires patent rights for $100,000 for $100,000. Although the patent would not expire for 14 years, its remaining useful life is estimated as 5 years. The adjusting entry to amortize the patent would be as follows. But one thing I want you to pay attention to. The patent would not expire for 14 years. That's the legal life. However, the remaining useful life, or economic life, or the technological life, is only 5 years. So which one should we use? We always use the lowest, the shortest. So we're going to use the 5 years. So as you can see here, the patent amortization was the $100,000 divided by 5 years, because that's the remaining useful life, and that gave us $20,000. So we debit amortization expense for patents and we credit patents. Please pay attention that we only credited patents. We didn't credit accumulated amortization for patents. So for companies that develop their own patents through research and development, any research and development costs are usually recorded as current operating expenses in the period in which they are incurred. Now let's talk about copyrights and trademarks. In copyrights and trademarks, we're all familiar with that. These are like things related to artistic or musical composition, or even a book like literary. So the exclusive right to publish and sell a literary, artistic, or musical composition is granted by a copyright. Copyrights are issued by the federal government and extended for a little bit longer period than the patents, which is 70 years beyond the author's death. So after the author or the creator of this musical composition dies, 7 years after, the copyright still exists. The cost of a copyright include all costs of creating the work plus any other cost of obtaining the copyright. A copyright that is purchased is recorded at the price paid for it. Copyrights are amortized over their estimated useful life. A trademark is a name, term, or symbol used to identify a business and its products. So unlike copyrights, which is something like a song, a movie, or a book, a trademark is like Nike or McDonald's, the logo and the name. So most businesses identify their trademarks with the R in a circle, and sometimes they use the TM standing for trademark, and they use that for their advertisement on their products. So under federal law, businesses can protect their trademarks by registering them for 10 years, and then they can renew it for 10 years or keep doing it every 10 years. Like a copyright, the legal costs of registering a trademark are recorded as an asset. If a trademark is purchased from another business, its cost is recorded as an asset. In such cases, the cost of the trademark is considered to have an indefinite useful life. Therefore, trademarks are not amortized, but rather reviewed periodically for something called impaired value. So we do some kind of an impairment value test every year, and that's the way when we see if it lost its value. So when a trademark is impaired, the trademark should be written down and a loss is recognized. So let me stop here. In the next video, I'm going to continue the discussion of intangible assets, and we'll talk about goodwill, and we'll wrap up the chapter in the next video.